Hello, my name is Eric Lund, and I'm a senior economist at the Conference Board. Welcome to the November episode of Economy Watch. We appreciate you taking the time to talk to us a little bit today, or with us, I should say, about the global economic outlook for 2021 and what we expect in various parts of the world in terms of the recovery. So this month, we're going to be examining when will major economies and the global economy at large emerge from the pre-pandemic induced recession? What will the economic growth look like around the world over the next decade, so a little bit longer term view? And then what are some of the trends within capital, labor, and productivity that are going to shape that longer term economic growth? Finally, we're going to touch on some of the trends that are coming out of the COVID-19 pandemic, including the surge in digital transformation that we've been seeing over the last 9 months or so. Let's see. As always, we offer CPE credits to our viewers. Make sure to stay online for the entire webcast. You'll need to enter your name into the box at the bottom of your screen, and there are 3 pop-ups that you'll need to click on over the duration of the next hour. I'm very pleased to introduce some fantastic speakers that we have with us today, all from the Conference Board. Joining me are Kshape Recovery, an economist based in
Eric,
Brussels.
Thanks for having me.
Ilaria Maselli, our senior economist for Europe, who is also in Brussels. Hello, Ilaria. Hiba Akani, our senior economist for the Gulf, who's based in Kuwait. Welcome, Hiba.
Hi, Eric. Thank you.
And unfortunately, our senior economist for China, Gao Yuan, who is based in Beijing, is not able to join us due to some connectivity issues. But I want to go ahead and launch straight into the topic. We are going to lead off with a poll question. If we could bring that poll question up, please. So recent news about a potential COVID-19 vaccine has many hoping that the global economy will continue to recover in 2021. When do you believe that the global economy as a whole will return to pre-pandemic GDP levels? There's a variety of answers here. First quarter of 2021, second quarter of 21, third and fourth quarter of 21, or not until 2022. So let's see here. We have a fair number of votes that have come in. Maybe we can lock that up, if we may. So, interesting. 2022, overwhelmingly, over about 60% of the respondents are thinking not next year, but the following year. About a quarter of you, late 2021, 15% Q3, and very, very few Q1 or Q2. So of course, I think that your perspective on this is maybe to a certain degree colored by where you're actually voting from. Somebody who's in Germany may feel slightly different than someone in the US or in Kuwait, for instance. But let's get a response from some of our panelists. Ilaria, any thoughts on what the audience is telling us?
Look, I thought we were the pessimistic ones, but I see our audience is much more pessimistic than us. So I think this puts us on a good starting point that we can share, we can uplift our audience today.
What about you, Hiba? Do you have any, does this surprise you at all, given where you're sitting in the Gulf?
I think it makes really good sense for the Gulf region, definitely with the oil prices. So 2022 sounds reasonable to me at this point.
Well, I know that from a Chinese perspective, the rebound there has been a lot stronger than it has been in other parts of the world. We'll talk about that a little bit later in the program. But Klaus is our sort of major engineer behind our global outlook. So we can get the definitive answer from him, of course. What do you think, Klaus?
No, I agree with what you guys have been saying. It's very much depends on where you are in the world, but not only that, also the sectoral in which industry you're all are also matters. So by region, I would say probably some of the East Asian economies are probably going to return quicker to pre-pandemic levels than, for example, Latin American countries. with the EU and US sort of in the middle. And in terms of sectors, it's probably, I mean, the face-to-face services, tourism, airlines, these kind of industries, but also capital goods producers. Those are the sectors that will take much longer time to recover versus, for example, the consumer goods producers or retail trade, where indeed we already have seen some of us. In some countries, those sectors are already back to pre-pandemic levels. Now,
Now, I know you have some material on how individual economies have already, what their status is right now. Can you walk us through a little bit, you know, what we're seeing?
Yeah, so this is indeed the time that that the Q3 GDP figures are dropping in. We don't have all economies yet, but we have a relatively decent sample. So I put some major economies here. And what we have here is basically we define pre-pandemic as the GDP levels of the end of last year, and we compare them to what they most recently reported, which is the Q3 numbers. And you can already see, indeed, as we said, some economies in East Asia, China, Taiwan, Vietnam, their economies are already producing more than they were before the pandemic. Then you have a sort of a second group where levels are still below pre-pandemic levels, but by a smaller margin, right, around 2 to 5%. So some of the major European economies are here. US is there as well, and so are some of the big emerging economies like Indonesia and Saudi Arabia. And then I see a sort of a third group, which is further out from achieving pre-pandemic output activity levels, so to say. And in that group, I would put countries like Mexico, Spain, and the UK. So interestingly, even within a region, you have these varieties, right? So you have Spain and UK, which are much lower than for example, France and Germany and Italy. So that's where we are now. Coming back to the poll question, I think, so on this chart you said we have it broken down by mature economies and emerging markets, sort of these aggregates, and the global economy would sort of fit right in between those lines. So based on our most recent estimate, I would put the number at around Q2 or Q3 of next year, that the global economy as a whole is sort of back to the pre-pandemic output levels. Now, for mature economies, it will take a little bit longer. As you can see here, it's probably not going to be before the end of next year that they will be back to pre-pandemic output levels. After a quick bounce in Q3, we expect some of them to already, we see some slowing in the recent months, and we expect that to persist in the winter months. But as of, especially from the second half of next year onwards, we expect it to speed up there again. Emerging markets have a stronger recovery. You can also see that here. They will be back to pre-pandemic levels, perhaps already by the end of this year. Of course, China is a large driver in this, but some other, it's not only China, but there are some other emerging markets as well. However, as you can see, we put here in the sort of shaded lines are the response to the global financial crisis. And there you see that the emerging markets performed much better after the global financial crisis. They had a much stronger recovery compared to what we're seeing now. And in that sense, the mature economies are slightly above their post-financial crisis recovery path.
What's driving that, Klaus? You know, why were the emerging markets able to sort of rebound from the global financial crisis so much more effectively than we expect them to be able to rebound from COVID-19?
Oh, we'll get to some of the longer term trends in a minute, but part of it is because they're simply growing at a slower rate. They have, some of them have caught up very quickly over the last 2 decades, and that sort of catch-up growth is slowing down. You also have some country-specific factors. Remember, China did a huge stimulus. Maybe we'll talk about it a little bit later in the China section, but following the global financial crisis, that they did a massive massive stimulus which actually helped the global economy by a large margin. All those factors are not so much at play this time. For mature economies, a large factor is the euro area that went into a double-dip recession. So, of course, we haven't penciled that in right now, so that is perhaps one of the reasons why we expect this recovery to be a bit faster. But of course, if that still happens, then we could be back at the old recovery path.
Why don't we talk a little bit about that long-term outcome and how we at the Conference Board are thinking about this, the kind of inputs that we assess when we think about the next
Sure.
decade.
So when we assess the medium-term, the long-term potential of growth of economies, economic growth, we look at the factors that drive growth from the supply side. So think about your own organization, your own company. How do you expand your production? How do you expand your output? We roughly think of it as two ways to do it. One is from a more quantitative side, so you can simply hire more people or let your employees work more hours, put in more hours. And secondly, you can buy more capital for them to work with, so the capital output ratio goes up. Those are sort of what we call quantitative growth drivers. And then, but another way you can increase your output is by focusing on more what we call qualitative growth sources. So that basically means you're doing the work in a smarter way. And there you can think of upskilling your workers, either through education or simply through experience. They become better at doing their job, so that also drives, of course, your output growth. Second factor is you can sort of upscale, quote unquote, your capital stock, so you can switch to more, typically more what we think of are digital assets, ICT assets, software, intellectual property products, things like that. R&D is also a part. And then finally, that sort of elusive concept of productivity, which is sort of, which you can think of as an overall efficiency improvement. So those things that you cannot account for by putting in more hours or working smarter, whatever extra output you produce, that is explained by what we call TFP, total factor productivity. So those are the green.
And for the global economy for the next 10 years, what are the primary drivers, given these sort of categories that you've just gone over, that are driving the global economy forward?
Yeah. So when we make these projections, we don't project GDP as such, but we really focus on all the we project all these factors that we just talked about for each of the 77 economies that we have in our model. And I should say, if you're interested in the details or interested in more data or whatever, I mean, we have a website dedicated to this, and you can also always, of course, reach out to me. But that having been said, some of the main findings is that we see a slowing in the global growth rate, as you can also see here. And that is mainly because of slowing in the quantitative growth drivers. And that's a bit of a change from the experience of the last 2 decades, roughly 1-2 decades, as you can see in the chart, which were heavily driven by quantitative growth sources. So you had a big investment boom, for example, in China that is popping up here. You had a booming jobs market, both in Europe, in the US, but also other countries like Japan. So that, of course, gave a big tailwind to the global economy. So we expect that to change over the next 10 years, basically. There are some structural factors at work, like aging. Many societies are aging, not just advanced mature economies, but also some of the emerging markets. So that will basically mean that there's fewer growth in the labor supply, and connected to that, there's also going to be less investment, so that sort of hampers your quantitative growth drivers. But on the upside, we do expect, as you can see, the green part in this chart in the last column is a bit bigger than it was before, so we do expect
I'm going to go ahead and move forward a little bit. We're having some connectivity issues with Klaus, but that's okay because we're at pretty much the end of his material. I wanted to pivot a little bit. So we started out really big picture, high level. I talked a little bit about the global economy at large and how we think about it in terms of these components that Klaus went over. But we're going to talk about the U.S. economy. We're going to talk about Europe. We're going to talk about the Gulf, and of course, we'll talk about China as well. So in terms of the U.S. economy, we're going to start out by discussing our short-term outlook. So this is not the long-term outlook that Klaus just went over, but what we're expecting really for 2020 and 2021. This has been a very difficult year to be in the world of forecasting, and we've pivoted the way that we assess what is happening in the U.S. economy and some of the other economies that we do forecasting work in, including Europe. What you're looking at here are three different scenarios for what we see ahead over the next 12 to 15 months. The three lines, the black line is our base case forecast for U.S. GDP, U.S. economic growth. The orange is the upside forecast, and the blue is the downside forecast. So in order to build these, we actually tear the U.S. economy apart into about 15 specific high-level industries. So we look at things like manufacturing, we look at things like business services or education and healthcare. And we make individual assessments on what we expect these industries to do over the coming year. And we weave all that back together to get to this aggregate economic sort of GDP concept. Each one of these scenarios is underpinned by, of course, a number of assumptions. We have identified really, 5 pivotal kind of assumptions or variables in terms of things that are currently unknown, but that are really going to shape what we see over the next year. Those variables include COVID-19 and lockdowns that are associated with COVID-19. So we're seeing an uptick in the number of cases in the U.S. right now. It hasn't gotten to the same scale yet that my friends in Europe right now are currently grappling with, but there's certainly a possibility that could happen. The health of the labor market and consumption trends is another variable that we're watching closely and that we think is key to making assertions about what we expect over the coming year. Government stimulus. We're still waiting for a second sort of fiscal package from Washington, D.C. There's a lot of question marks in terms of how big it might be and when it might occur. The big one for this week especially is the vaccine in terms of when it's developed, when it's approved, and the degree to which it's made available to people in the U.S. Next year. And there's a little bit less ambiguity surrounding this one. We had some concerns about the election and volatility in terms of the outcome, but it looks like things are trending towards a more accepted win. And a political transition is still a bit of a question mark in terms of what kind of volatility that introduces, especially for consumer confidence and business confidence. So in our base case scenario, we assume that we don't have a major resurgence in COVID-19 over the next couple of months, that the lockdowns are intermittent and localized. We assume that there's limited improvement in the labor market, at least through the end of the year, but we start to see that reverse a little bit into maybe the second quarter or so of next year. This base case also assumes that we do get some sort of a stimulus package out of the Congress, and that it probably gets implemented in terms of people actually seeing the money, businesses actually seeing the money towards the end of the first quarter or early Q2 of next year. The vaccine, we had great news about that, but it'll take time for manufacturers to scale up the amount of inoculations that are available and to distribute them. So it's not likely that we're going to be able to see, in any given place in the country, if you want a vaccine, you can get it. That's probably not going to happen until the second quarter, maybe the end of the second quarter of next year. And again, the political transition, we expect it to be not too disruptive at this point. So that's what yields this black line here. For the year at large, this gives us a contraction of about 3.6% for 2020, but an expansion of about 3.4% for 2021. But if a lot of those key variables that I just mentioned deteriorate, if we don't get stimulus, if the vaccine gets postponed, if the COVID outbreak is much larger than we currently envision over the winter here in the U.S., it puts us on a downward path, that blue line. So we have the potential to start seeing economic output begin to contract again. We don't think it'll contract to the same degree that we saw early in 2020, but certainly that it is problematic, and it will take time for us to find our footing once again. On the upside, if everything goes right, if we get a stimulus package before the end of the year, if there's no lockdowns from COVID over the winter, then there's the potential that we could grow out of this recession even faster. So the potential for somewhere in the order of 6% annual growth for 2021 could be possible. So our base case, we think the black is the most probable path forward, but there's certainly upside and downside risks to that. I also want to touch on the longer term view. So Klaus walked you through some of the pieces of this puzzle in terms of what we expect to drive growth over the next decade. For the U.S., it's an interesting story. As you can see, for the 2020 to 2023 period, we had that big block of red that's beneath the zero level. That is labor quantity. And we expect labor quantity to be a drag on U.S. GDP growth over the next couple of years. We call this period of 2020 to 2023 sort of the COVID-19 period because the ripples of the virus and the lockdowns will be felt not just in 2020, but over the next 2 years as well. And what this is telling us is that people dropping out of the labor force, people who are retiring early, basically just the quantity, the number of people that are available to contribute to growth is likely to contract over this period of time, which is going to drag down overall U.S. GDP growth to about 1%. So that's the average growth rate that we expect to see over this 3-year period. On the upside, there are some sort of dividends, surprisingly, that fall out of the pandemic. The four of us, for instance, that you're watching right now, we're all working from home. A lot of you are as well. So this shift towards telework, towards digital transformation, more e-commerce, introduces greater efficiencies and productivity gains that we expect to pay dividends later on in the decade. So that dark green bar that you see at the top of the stack from 2024 to 2030, that's the positive sort of contributions that result from this early adoption or accelerated adoption from digital transformation. Now, to be sure, the work towards telework or e-commerce or remote learning, these were all trends that had been steadily growing before the pandemic, but the pandemic really compressed the adoption time frame. So we've seen perhaps several years worth of adoption compressed into a 9-year period or 9-month period. And we think that that's going to really help to boost the economy, the U.S. economy later on in the decade. So that's sort of a broad overview of how we are thinking about the U.S. Both in the short term and in the medium term in our global outlook. But I want to spend some time exploring Europe because their story is a little bit different. And fortunately, we have Ilaria to hold our hand and walk us through that part of the global economy.
Thank you, Eric. Well, it's not easy to talk about Europe right now because, of course, all eyes are here given the resurgence of the pandemic that was, let's face it, faster and happened sooner than we thought initially. So this is, of course, an interesting time to look at this part of the globe and how we think this is going to evolve. So several European countries are currently in lockdown. It was not coordinated explicitly, but it ended up being at the beginning of November in several countries. And I have to say, I don't have the feeling that this is the same lockdown as it was in March and April. So the amount of restrictions are, of course, quite high, and that's why we call it a lockdown. But they're not as high as we've seen in the first lockdown. And the proof of that you can see if you look at the Google Mobility report, which is what you have here on the table, on the blue table on the left-hand side of the chart. So what you see there in the first column is the decline in mobility during the first week of April, which was a period in which more or less all European countries were in lockdown. And then the latest data, which is the first week of November, so first until 8th of November. So what you immediately see without doing too much calculation is that the current decline in mobility towards workplaces, towards retail, is basically half, more or less, of what we saw in the first lockdown. So that's already a first proof that this lockdown is in some ways lighter, and this means we'll have also lighter impact on the economy, of course. The other issue is duration. So for the time being, in most countries they announced restrictions for about 4 weeks, and if you remember, beginning of the year, this was more for 6-8 weeks that it was announced. Then in some countries like UK and Italy, they're taking a more like a regional approach, so not applying the same measures at the same time everywhere, but monitoring how this is going in each region and then applying restrictions, more or less restrictions depending on how the pandemic evolves in that area. And then I think this is a very important part of the reaction to the second wave is the fact that, unlike in the first wave, there is a very clear commitment in many European countries to keep schools as much as possible open and as long as possible. I have to say there is one more element that is different, but on the negative side of things, and that's the fact that there is a feeling that the societal acceptance of this lockdown is less. And it's very difficult to measure these things, of course, but there were some riots in Italy when the first restrictions were announced, and that perhaps is an indicator of the fact that, you know, it's very heavy from the social point of view, also from the psychological point of view for every person. So this is where we are right now. Now, where are we going next year? We are, of course, everyone is making scenarios. We did the same because the level of unpredictability is still very high, and I guess I change my mind every couple of hours of which scenario is going to prevail. So let me go through the two scenarios. They're of course not very different from yours, Eric, from what you're preparing for what you prepare for the United States. But I honestly prefer to switch to have two scenarios rather than three, because if you have three, you will choose the middle ground as a safe, you know, to minimize the error. But if you have two, you really have to say, okay, so go that way or that way.
Not my secret.
Yes, but this is why I change my mind every couple of hours. So, first scenario. The first, the assumption is, of course, that there is a possibility that COVID is controlled, and through a combination of a vaccine or better treatment. And this, of course, has a strong economic impact because confidence is up, consumer confidence, business confidence, and so people consume, business invest, and things go in a positive circle of things. This would translate into GDP growth of, let's say, more or less 5% in Germany, 8% in the UK, 7% in Spain. So rather big numbers here. Now, for those that are listening from the US, these may seem like very big numbers, but you also have to consider that the contraction in Europe this year is expected to be twice as big as the contraction in the United States. So in the US, we are at what, 3.5% more or less contraction?
Yeah.
Whereas in Europe, we are estimating Euro area minus 8.8 and UK minus 10%. So completely different numbers. Now, the second scenario is, of course, more pessimistic. And we have to say, in these days, we started to, the last days, especially with the new lockdown announced, we switch more and more towards the second scenario, because there the assumption is that bigger lockdowns are needed, that this brings more unemployment losses, and therefore consumer confidence goes down. It's also possible that fiscal policy doesn't work as well as we would like. There is a lot of discussion in Europe on whether really this new EU package, the next generation EU package, will it kick in on time to actually help the economy or not? So this is still not clear. And so this would translate into a growth rate for GDP that is about half of what we expect in scenario 1. Now, for the long term, it's not more entertaining because what you see on the chart is more or less the same chart you saw for the global and the US, but what I put here is actually a comparison of what we expect for the euro area after the storm passes compared to other big economies, other advanced economies. So, second column, euro area, you see what's expected in terms of GDP growth for the period 2024-2030 is something like 1% a year. And it's not too different from Japan, but it's very different from UK and US, where we expect something more like 1.4, 1.8%. So I really wanted to put this chart here to emphasize really why is Europe different, why is growth so weak here, the growth outlook so weak here. And I think if you look at the color combinations, you can come up with the answer yourself. What is really weak in Europe is everything that is quantitative. So we know that when an economy is an advanced economy, a mature market has to grow by qualitative inputs. I mean, that has to be the main thing. R&D, efficiency, productivity. These have to be the drivers of growth for a mature market. But despite that, countries like the UK and the US still manage to have a positive contribution from the quantitative inputs of growth. So the pinkish and reddish part of the chart still bring something to GDP growth. So there is still more people that are added into the labor market. There is more capital that is added into the economy, and that pushes growth up by 0.5, 0.8% every year, which is quite a lot. Whereas in Europe, basically, the demographic developments weigh enormously on growth. They detract from growth a lot. We are at risk of a shrinking population and we are a shrinking labor force, and that is, of course, a problem. And so that needs even more effort to, compensate for that with productivity.
Thanks, Ilaria. We don't have any questions yet. We actually love the audience to engage and ask questions. We weave your questions into the dialogue, so feel free to enter them in the box on the bottom left. I want to pivot a little bit and
Ilaria,
sure.
Can I ask a question? Sure. Ilaria, can you comment a little bit on some of the recent developments, how they will impact growth in Europe? So I'm thinking, for example, on Brexit, how that will play out, and the Biden presidency. Is that in any way figured in this, or is it this too long term for that?
So I think the change, the political happenings in the US don't enter the supply side model. So that is more like a qualitative judgment. And if I can make a qualitative judgment there, I think the interesting thing for Europe might be the return of multilateralism. The export sector is really key for the growth in Europe, and we're a big open economy, and the fact, all these tensions around trade that happened in the last couple of years were really detrimental for growth here as well. So I think a more multilateral approach, a more looking at trade in a positive way, will have a qualitative impact on Europe as well. So that's on the Biden side. On Brexit, well, we worked on the model together on this graph, and we actually tried to incorporate that, and that of course brings a minus into the UK growth. So the growth in the UK would be higher than 1.4% per year if our assumption is that there won't be a trade deal, or if there is one, it will be very limited on goods, so nothing major between the UK and the EU. And so the way it will influence is that we expect the UK to be a less open economy from next year if there is no deal, and that of course will take some points away from growth.
All right, I want to follow up with an audience question that I think is sort of applicable. You have a question here. So do you see any regions adopting broad-based universal income to respond to COVID? And if so, might those programs durably impact the economy? I don't know if we've seen the wide-scale introduction of new economic policies in any of the major economies, at least, but certainly I think that there are structural sort of safety nets that are present in Europe that aren't present in the U.S., and that they help to differentiate the way, especially early in 2020, the lockdowns hit the economy, both economies. In the U.S., we have less of a social safety net, so we had to sort of scramble to try to get some of the stimulus money out. But in Europe, I think it was a much more sort of organized and more quickly sort of introduced process because of the way that the economies there are run. Does that sound about right to you, Klaus and Ilaria?
If I may quickly weigh, I think it's interesting actually. You mentioned the stimulus in the U.S. In some way, you could say it was sort of a universal basic income, right? I mean, there was just checks being well in Europe, it was very much tied to jobs. So in that sense, the U.S. Even though of course it was a temporary program, but in that sense, the U.S. Seems closer to universal basic income than Europe. Ilaria?
Well, yeah, no, I think we have seen in this crisis on this side of the world an exceptionally high commitment to protect jobs. And of course, this was facilitated, as you said, Eric, by the fact that a lot of these programs, like furlough schemes, Kurzarbeit, chômage partiel in France, etc., they existed since a long time in all the countries. So what happened? They didn't have to invent them. Workers and companies were aware of that since a long time, and all countries had to do was just to expand them. For example, to extend them to smaller companies if they were not eligible and things like this. So the attention has been really on jobs, and you can see the result of that is the fact that unemployment has been growing, of course, but much less than what we saw in the United States. And I think the advantage was really to have all of those programs in place since a long time so that countries were not completely surprised by the recession.
We also have a question on the K-shaped recovery, which is there's been a lot of letters basically that have been used to describe what kind of a recovery various economies are undergoing: a V-shape, a W, a swoosh. But the K is an interesting one. The K-shaped recovery is about some segments of society recovering a lot more rapidly than other segments, and creating sort of a bifurcation in demographics or in industries in terms of how they emerge from the pandemic. And I think the answer is in the U.S. we are seeing that. We're seeing certain groups of workers being able to come out of this. They're able to work from home. They're not facing the same kinds of layoffs that other workers are. Specifically, the services workers in the services sectors who typically maybe don't get paid quite as much. These are restaurant workers or people who are working at theme parks. Places like that, places where social distancing is really having an impact on their ability to function. Those workers are really bearing the brunt of the pain, at least in the U.S. This year. And we see that we also see that the workers who haven't been hurt as badly are actually saving a lot of the income that they're generating. So if you look at the household savings rates on a monthly basis, we're seeing, especially early in the year, we saw household savings rates go up to around 30% of income. And that was associated with these high income earners. They were spending money. They were spending money on durable goods, manufactured goods, things that they could use at home where they didn't have to expose themselves to the virus. They weren't spending money in the services sector. And so you have this a pivot in spending patterns that exacerbates things even more. As the economy opened up a little bit over the summer, people still weren't super comfortable going out to restaurants and doing social things. And so the kind of rebound in the services sector, especially among these low-income workers, really was even more pronounced. So that's a key kind of dynamic that we have to watch as we go into 2021. It's about unlocking the savings, the spending habits of the higher income workers, getting it back into the services sector to help that element of the labor force start to recover a little more rapidly. I want to move on a little bit because we've had some great questions from the audience, but I want to give Hiba a chance to talk about what has been happening in the Gulf. So Hiba, Why don't you walk us through some of your material for 5 to 10 minutes, and we'll see if we can get some good audience questions.
Sure. Thank you, Eric. I'll start off quickly by presenting the Gulf region for the participants who are unfamiliar with the Gulf. So basically, the region consists of 6 countries: Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the UAE. The region, of course, is known for being a global oil exporter. The oil production of those countries is around 54% of OPEC oil production and around 20% of the global oil production. So the first thing that comes to mind with COVID and its impact on the region is, with the fast spread of the virus, this led to global mobility restrictions and multiple lockdown periods across the world. So basically less transportation and less aviation activities. This translated into an unprecedented decline in oil demand, and basically it was the sharpest, I think, since the Second World War. So with the decline in oil demand, the storage capacities filled up drastically, onshore as well as the sea oil tankers. So the capacities were at full capacity, and this led to a steep decline in oil prices. We've seen oil prices drop from $80, $70, and $80 per barrel to around 20. Even the forward contracts were in the negative territory, I think in March, if I'm not, May, sorry. So actually sellers were giving money away to buyers to buy those barrels. So COVID will eventually contract the Gulf economy by 5% in 2020. United Arab Emirates and Kuwait are mostly affected. We expect a contraction of 6.5% and 6% respectively for Kuwait and the UAE. Saudi Arabia is slightly more resilient at minus 4.9. Maybe with the recent figure for GDP for Q3 as class has shown, there was some improvement, so maybe this figure would change by the end of the quarter. By end of Q4, we might see a number around a contraction of minus 4 to minus 4.5% instead of the minus 5%. Qatar is the most resilient among the 6 countries. It is less dependent on oil. However, it is one of the largest energy producers and exporters. So how do we move? How is the GDP or how is Corona going to affect the budget deficit? So we said that low oil prices, low oil demand, this will translate into depleted oil revenues, and this will cause double-digit deficits for the region. So all of the 6 countries are facing high deficits and rising debt levels. As well, most of the governments are trying to push the reform agenda to diversify away from oil. So if you look at the... Sorry.
You talked about, so some of these economies are a lot more dependent on oil revenues than others are. And there's been a lot of, I think, emphasis put on trying to diversify some economies. And we're really seeing in the numbers that you're showing us, those economies that are more diversified are being less impacted by the global shock to oil prices. Moving forward, do you think that some of these governments are going to take a pretty strong message away and double down their efforts to try to develop the services sector and manufacturing sectors and really try to even move away from oil even more than they already have?
Yeah. Actually, the Gulf region has been at this crossroads several times. It has been there during the financial crisis. They were there in 2014, 2016. And every time we face this dual shock of supply and demand, we say the governments are going to take serious steps towards diversification. And every time we are, unfortunately, we do not see the expected plan come to turn into reality. However, after 2016, most countries have released their Vision 2030, Vision 2020, basically focusing on those diversification efforts. They want to enrich and empower the private sector. They want to try to funnel the oil revenues away from the usual projects which are low productive. We're hoping UAE and Saudi Arabia have made tremendous steps towards diversification. We have those giga projects in Saudi Arabia that are promoting tourism, manufacturing, and so on. UAE, of course, with Dubai, because Abu Dhabi mainly is an oil-producing emirate, while Dubai doesn't have any oil. So Dubai is more about innovation, SMEs, and the private sector services, and so on. I hope the remaining 4 countries would invest their financial reserves towards those diversification projects.
And what about the longer-term outlook? I know that we talked a little bit about what we expect over the coming decade for Europe and for the U.S. What about in the Gulf?
Okay, so I'm going to skip this one. The longer-term outlook is basically dominated with the oil outlook, right? So those oil diversification policies are going to take time to bear fruit. So we expect oil prices, as per the international agencies, IEA, EIA, and even OPEC, we expect oil demand to plateau in 2030s and oil prices to remain subdued. This will eventually limit the potential of government contribution to the economy. If you look at the chart, for the last 2 decades, capital quality was the main driver of growth and labor quantity. This is basically government investing all the oil revenues into infrastructure, construction, transportation projects that are unproductive, if I may say. And with the declining revenues, we have declining capital quantity and expat labor leaving the region. However, by 2024, things might start improving. We have the digital acceleration and digital transformation, investment in ICT, more education, better education for national labor. This will drive, it will lower the negative CFP, pushing the growth of the region to around 2%. However, it's still much lower than what we've seen before. We have 4.1% in early 2000 and 3.3% during the last decade.
Thanks very much, Hiba. That was a great summary.
Hiba, if I may ask a question, so how important do you think it's that the fact that mature economies, or Europe or US, and we'll talk about China in a second, how important is their recovery for the Gulf region? How does it feed into their long-term?
Definitely the recovery of China, because it's a main customer, if I may say, for the Gulf countries. So definitely the oil demand for the Gulf region is mainly driven by emerging countries and China, and the LNG in Europe for Qatar. So definitely it is crucial, important, and that's why the external sector is always providing some sort of volatility to the economies, and we cannot reiterate enough the need to shield the Gulf economies from the external sectors.
That's a good point, and thanks for bringing it up, Klaas. Speaking of China, we want to spend the last few minutes covering the China section of our global economic outlook. As I mentioned earlier at the onset of the program, unfortunately, our China economist, Gao Yuan, based in Beijing, has some technical difficulties getting on the webcast today. But I think between the four of us, we know enough about China to come up with some interesting things to say. So let's start out by talking a little bit about when we can expect the Chinese economy to potentially come back to a pre-COVID-19 status. So the Chinese economy is on a steady rebound, really, and it has been since the second quarter. But that doesn't mean it's anywhere sort of in sort of normal operating conditions. It's been a pretty unbalanced recovery. The recovery has really been focused on industrial production, so factories churning out goods, but really has lagged in the household consumption sector. And so moving forward, in order for China's economy to continue to recover, there's going to have to be some shifts that take place. So if GDP growth goes back above, let's say, the 6% level, but it's all associated with capital formation and industrial output as opposed to services and household consumption, then it's really not a normal recovery. The numbers may be better. The headline GDP numbers may have improved substantially, but the underpinnings of that recovery are structurally unsound. I don't know, Ilaria, Klaus, do you have any comments on this shape of the recovery in China?
Yeah, perhaps I wanted to add something which I understood from our colleagues in Beijing, and I think it's very relevant at this moment. It's very interesting right now. So, I mean, okay, just to take one step back before COVID. So China is in a transition where more of its economy should be driven by consumption and less by investment, and that's the way to make growth more sustainable in the long term for the country and more efficient. But I understand that really COVID is really questioning that transition, that process, because consumption growth is indeed weaker than it should be, and that's because well, two things. One is that income growth in general is weak, and that of course if income growth is weak, then of course consumption growth will be weak as a consequence. And one reason for that, and I think that's really the most interesting part of it, is that what I understand from colleagues in Beijing is that there is an inequality element in there, so that income inequality is increasing as a result of this crisis, and this is what behind the weak growth in consumption. And yeah, and I really wanted to point it out because I think it's a relevant one.
No, that's a good point, Ilaria. I mean, the unemployment rates, the official ones at least, have been improving over the last couple of months in China, but that only captures one kind of dimension of the labor market struggle there. There have been widespread salary reductions that have been implemented, and of course that has an impact on the consumer as well.
And now it works because part of the unemployment effect of the crisis is really in the unemployment rate, and part of it is in the fact that people are working less hours in some industries, and that is probably what we see here happen.
So maybe we could talk a little bit about what sort of happened in the immediate sort of aftermath of COVID in China. Prior to the pandemic, China's economy had been on a transformational pathway. There was a structural slowdown that was occurring. Klaus referenced earlier on in terms of the post-global financial crisis recovery. There was still a lot of catch-up potential for emerging markets and China specifically. But a lot of that catch-up potential has been realized. And so the incremental growth numbers, as you approach sort of the boundary of what's possible, that starts to slow down. And our thesis for this that we revealed a number of years ago is called the long soft fall in Chinese growth. And we continue to expect, we expect to see a resumption of that sort of structural long-term trend even after the COVID period has come and gone. We saw a pretty sharp deceleration in nominal GDP in 2017, as you can see here in the chart. that was associated with some of the other structural problems that China has been grappling with as well. Following the global financial crisis, there was massive stimulus that was poured into the economy by the Chinese government. And as a function of that, there were a lot of excess capacity, especially in the state-owned sectors, which tend to be more inefficient, but also in things like infrastructure as well. And it created a lopsidedness and some actually financial risks in China's economy that they really tried to grapple with, especially in 2017 and 2018. They weren't able to solve all those problems, however. There's still a lot of excess capacity in sectors like steel and in coal, and there's still some debt issues, although those have been slowly been resolved as some of the bank loans that were made for infrastructure programs have been rolled over into the bond market. But there's still work to be done in these areas. It's not over yet, and China's going to have to tackle these issues again in 2021 and 2022 following COVID. Indeed, to a certain extent, the lack of fiscal stimulus that China has sort of poured into this period is associated with sort of that hangover from the global financial crisis and lessons that have been learned in terms of the limits of mass debt-fueled infrastructure investment that were learned about a decade ago. Klaus, Ilaria, do you have any comments on this? Hiba?
Maybe.
Yeah, I would just to make sure that in our outlook now we're looking at the official numbers, but I should mention that if we look at the longer term numbers in a second, and also the main numbers that we use in our outlook are sort of alternative estimates for China, which are a little bit lower than the actual real GDP growth rate. So I just want to be clear that. Also, I want to add that the if we look at the previous slide, again we talked about the consumption recovery really lagging so far, the actual recovery, and I think again that has to do with the difference in the fiscal response, which was first of all much stronger in Western mature economies, and was also in mature economies much more focused towards keeping the household income up, while in China it was much more, as you can see here, was much more driven by investment, and as a result industrial production and exports are doing very well, but the domestic market hasn't recovered in the way that it has in for example in Europe or in the US, where retail sales, for example, are already well above pre-pandemic levels. So but maybe in the final minutes we can turn to the last slide, sort of our longer term outlook. So I mentioned that we are working with alternative GDP growth rates. Again, if you need any details, reach out to me or one of us, or have a look at the website. So you'll see some lower numbers than what you're used to seeing. So, and as Eric mentioned, our main narrative for China is sort of this long soft fall growth path, where growth will slowly but steadily move into lower gear, basically. And you can see that the labor quantity component, for example, is also becoming negative, detracting from growth. That really has to do with the aging of the society. By some estimates, the population is already declining. The working age population was already declining for a couple of years. Again, also in terms of investment, Eric mentioned the deleveraging campaign since 2017. We expect that to continue. We expect that the policy priorities to really shift to improve this supply side efficiency. So maybe you can argue that we have a little bit of a benign view in that sense on China, and that's also why we think that productivity growth, which was quite negative in the last 10 years, again because of all this excess capacity that was being created, we think that that will also ease as the investment in excess capacity will slow. The productivity picture will also improve somewhat, even though it's still going to be marginal. Let me stop there.
Oh. No, we actually it's a good thing that you're wrapping up, Klaus. As we're approaching the end of the hour, I want to take a moment to thank everybody for joining us from the audience. I also want to thank Kiva, Klaus, and Ilaria for taking the time out of their day to tackle some of these issues with us. We offer some of the more granular details on individual economies in the deck. You can download that. It's available via this platform, so you can see the individual economies and how we think they're going to grow, not just in 2021, but also later in the decade. Join us next month for the Economy Watch. We are going to be tackling the global energy and specifically oil markets and what the implications are for some of the countries in the Gulf that Hiba spoke about today. And as always, we are doing a lot of work on the coronavirus that's available on our website. We do some great podcasts as well. Make sure to try to check those out. And feedback is always welcome. After we say goodbye, you'll have the opportunity to give us a review. Please do. It helps us. We appreciate it. Thank you again. Have a great day or evening wherever you are, and we'll see you next month.
Thank you.